Legendary investor Warren Buffett, the Oracle of Omaha, has over 57% of his over $300 billion portfolio in just two stocks. So in this video, I'm going to look at what those two stocks are and why Warren Buffett has so much of his portfolio in just these two stocks. It's surprising because all finance theory suggests that investors should benefit from diversification and diversifying your portfolio, but here you have arguably the best investor of all time not diversifying the portfolio. So let's take a closer look in this interesting portfolio combination.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so here is Warren Buffett's portfolio as of September 30th, 2023, which was reported to the SEC on November 14th. And you can see here, Warren Buffett has over 50% of his portfolio in Apple stock and over 7.15% of the portfolio in Coca-Cola stock, making up over 57% of his overall portfolio. So let's take a closer look at these two stocks and what has Warren Buffett attracted specifically to Coca-Cola and Apple. So starting with Apple's stock price, you can see in the last decade, Apple's price has increased meaningfully from around $20 per share on a split adjusted basis, all the way up to $182 per share as of this recording. Of course, Warren Buffett's Berkshire Hathaway's gains in Apple's stock has been widely publicized. Warren Buffett has made billions of dollars on this investment in Apple stock. It's proven to be a very lucrative investment. And one of the reasons for that is Apple's an incredibly profitable company, generating a 30.76 operating profit margin. Remember, operating profit is your profit that's left over after all your expenses following sales. So it's what's left over before paying interest expense and taxes. And it signifies a strong business that's able to generate all this profit even after all its expenses are accounted for. Now, importantly, you'll notice that this operating profit margin is the highest it's been in the last decade at 30.76%. One of the reasons for this is Apple has done a great job building out its services business. Sales in its App Store, sales of Apple Music subscriptions, Apple TV Plus, etc., etc. Those revenues are more than twice as profitable as when Apple sells hardware, things like its iPhone, iPads, MacBooks, AirPods. Those are less profitable because Apple has to pay to make those. Those are physical things. Whereas the services, it pays to make it to begin with, but then the incremental subscriber flows straight to the bottom line because it doesn't cost Apple that much more money when one more person subscribes to Apple TV Plus, right? It's already paid for that content, and so one more subscriber doesn't really add to its costs, and so that makes it more profitable as millions and millions of people continue adding that service to their list of services. Additionally, Apple generates strong cash flow from operations at 30.19% in its most recent quarter. Apple's able to sell its products at premium prices because of decades of built-in trust with consumers. Also, Apple has a strong ecosystem. Once you buy an iPhone and you customize it, you add your music library, you add all your apps, you add all your services, you buy the Apple Watch, maybe you buy the AirPods, you're into Apple's ecosystem, which makes it difficult when it comes time to upgrade to switch to any other provider, right? So let's say you had all those Apple products, the iPad, the iPhone, the AirPods, the Apple Watch, and one of those needs to be replaced. Well, are you likely to switch to another provider, or are you likely to get the latest Apple version of whatever one of your consumer electronic devices you need to upgrade? You're likely to get another Apple, right? Because it mixes in with your other electronics and makes them more useful. The collection of devices are more valuable when you have them all together versus when you have piecemeal and all separate. So that ecosystem has created this strong brand loyalty for Apple, and that's been positive, that's been lucrative for sales, for cash flow, for profitability, and understandably, Warren Buffett is attracted to that. He likes that business proposition, no doubt, that customers are less likely to switch, that existing customers are likely to be long-term customers, which makes an investment even more worthwhile because the same customer sticks around for 5, 10, 15, maybe 20 years. So that's an attractive investment opportunity. And finally, Apple's stock has never truly been very expensive, even though the stock price has increased so much. When you look at the valuation metrics according to the price to earnings ratio, it hasn't gotten too expensive because the company has justified the stock price increases with improvement in profitability. So it's the profits that have been fueling the stock price increase. So it's not that the stock price is getting more expensive, it's that investors are getting more, they're getting more value, and so they're willing to pay more. The product, the investment has gotten better. And even now at a price to earnings of 28.45, it's not cheap. Apple stock used to be cheap at a price to earnings of around 10 in 2016, around 12 in 2019. Those times Apple stock was cheap. At 28.45, it's not cheap, but it's also not expensive. It's not so expensive to a level that would cause Warren Buffett to say, oh my goodness, this stock is way too expensive now. It should be time to sell. It has never gotten to that point. So he's just held on and accumulated those gains, and those gains has made the stock become more than 50% of his portfolio. Moving on to Coca-Cola. Coca-Cola, unlike Apple, has not experienced that significant increase in stock price. It's been more modest. You can see Coca-Cola stock price increasing from a little less than $40 per share up to $59 per share as of this recording. In addition to this, Warren Buffett has benefited from dividends that Coca-Cola has paid in this last decade. So Coca-Cola is a more modest gainer, a more modest increase, and that's understandable. Coca-Cola is not the type of business like Apple. It's not a fast-growing tech stock. It's a beverage company that relies on selling the same beverage to the same people who consume multiples of that beverage every day, every week, every month, every year. And so that's how Coca-Cola grows. Still, Coca-Cola demonstrates an excellent profit profile. You can see its operating profit margin 28.45%. That's up nicely from around 23% in 2015. So Coca-Cola demonstrates what's called economies in scale. It does better as revenue grows. It's learned to operate the business more effectively. It's learned how to distribute the logistics, all of that goes into the business. It's gotten better and better and better, and that's improved the profit all the way up to 28.45%, which is impressive for a beverage company. Similar story with its cash flow from operations, 26.38%. That's up from 24% in 2015. That's a more modest increase. Still, it's a solid cash flow from operations to sales margin, which measures how much a company turns sales into cash flow, how much sales become cash. And that's an important metric. And this is harder to do for a company that's 100% focused on selling physical things, right? Apple has the services business, which helps it generate stronger cash flow and stronger profitability. Coca-Cola is all physical beverages and products, and so it's harder to increase your cash flow from operations to sales because you're always having to replenish inventory, right? Once you sell 100 million units, you got to make another 100 million units. Otherwise, your sales will slow down because you won't have those products to sell. And like Apple, Coca-Cola stock has not really been expensive going back the last decade. This blip you see here was a brief moment when earnings temporarily fell, and that made the stock price appear more expensive, but it wasn't really more expensive. It was just a brief accounting earnings change. You'll notice that the stock price has never really increased by all that much in the last decade. It's up only roughly 50% in that time, total gains in that time. And as of this recording, it's trading at a price to earnings of 23.77. which again, it's not cheap, but it's also not expensive. It's not gotten to the point where Warren Buffett feels like it's a good time to sell the stock because it's so expensive. And given how long Coca-Cola has been around and its strong relationship with consumers and the habitual nature of its products, people who drink Coca-Cola drink multiples of Coca-Cola every day or every week or every month, and they keep coming back to Coca-Cola. And despite price increases, you've noticed that in the last 2 or 3 years, Coca-Cola has increased prices meaningfully, and consumer spending on Coca-Cola has barely nudged. People kept buying Coca-Cola even with its higher prices. So I hope this sheds some light on why Warren Buffett has so much of his portfolio in these two stocks and why he's never felt the need to sell. And it's not as if he's purchased all these shares to become such a large part of their portfolio. It's that the stock prices have increased, and as they have increased, they've just grown to consume a larger part of his portfolio, and he just hasn't sold. He's just kept on to it. He's the ultimate buy and hold long-term investor. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.